Hello and welcome to our discussion of Chapter 2. Now in Chapter 2 we're going to jump into financial statements and actually get prepared for talk about the accounting cycle. So in this video our main focus is going to be on those financial statements, just those three main financial statements that we have mentioned before. So why are financial statements important? There are two main groups of external decision makers that really rely on these financial statements for information and to help them make decisions. Those two main groups are your investors and creditors, and even prospective investors. Investors and creditors are both interested in the cash flows that they expect to possibly receive from a company in the future. Creditors, what are they worried about? They're worried about being paid back, right? They're worried that the enterprise or the company is going to meet its payment obligations. And that will include payment of the loan back to them as well as interest, right? Investors, they're interested in the market value of their stock and any dividends they might receive, right? And those concerns, you can point to these groups to the financial statements there. That's where they can get a lot of their questions answered. Okay, so these financial statements that we're going to be jumping into are very important sources of information. They are basically summaries of different information based on which one we're looking at. Okay, so financial statements, just at the basis of it, they are declarations of what is believed to be true about a company. Okay, and that information is stated in monetary units, in our case in dollars, right? So let me just write that here. It's basically a declaration of what is believed to be true about a company. Okay, whether it's the balance sheet, income statement, or statement of cash flows, that is at the end of the day what these financial statements really are. Okay, so when accountants, they're putting together these financial statements, they are describing to external users of that information, they are describing in financial terms certain attributes about the business. Basically, what is a representation of this business? Okay, what is a representation of this business's financial activities? Okay, so there are three primary ones. These aren't the only three that we'll be looking at in this class, okay? But there are three primary financial statements. And some of you hopefully remember what these three primary financial statements are from our Chapter 1 discussion, okay? That first one is the balance sheet. Second one is your income statement. And that third primary financial statement is the statement of cash flows. Okay, and remember the alternate name for balance sheet is statement of financial position. And the alternate name that you often might see for an income statement is your profit and loss statement. Okay, so for our purposes, when we are working through these chapters, for the most part, we're assuming that we're looking at a corporate form of ownership, looking at a corporation. Okay, when we work through the accounting cycle later on, though, that applies in general, but just know when we are working through these problems, we're assuming that we're looking at corporations, not necessarily a private business, okay, unless otherwise stated. Okay. So let's take a look at these three primary financial statements, and we'll start with the balance sheet. And remember, the alternate name for this balance sheet is a statement of financial position. So basically, this financial statement, it describes where the company stands at a specific date. So remember, this is our snapshot statement, right? It's like taking a picture, right? It shows where the business stands at a specific date, specifically as it relates to the business's assets, its liabilities, and its owner's equity. So basically, if you're looking at a balance sheet for the end of the year 2020, you should be looking at the balance of the company's assets, the balance of all of its liabilities, and the balance of its owner's equity accounts. Okay, so the feature of a balance sheet, you're always going to have a heading at the top and the name of the business, and then you also have to clarify the name of the financial statement. So I'll quickly paste an example in here so we can take a look. Oops, I did not mean to write on top of that. So let me move that down a little bit here. So you can see here is that we have the name of the business. We have the name of the financial statement, which in this case, they decided not to call it a balance sheet, but statement of financial position, and then the date. Okay. So we can see here that it shows the company's assets like cash, supplies, building, land, as well as its liabilities and its owner's equity accounts. And then all of these assets also have a total. So you have a total asset line, a total liabilities line, and a total liabilities and owner's equity line down at the bottom. So this is the general setup of what a balance sheet looks like. Okay, so sometimes you'll see the assets to the left and liabilities and owner's equity to the right, but sometimes they might all be listed. You'll have assets and then liabilities and owner's equity all listed on top of each other. Okay, as long as those categories are separated, but this is the most common way that you'll see that laid out. So before I jump to the other two financial statements, you're probably wondering, well, what are these three things, right? What the heck is an asset? If an asset is part of the assets are part of the balance sheet, I need to know what assets are. Okay, so basically, assets are those economic resources of a business, anything that the business owns. Okay, so it's an economic resource. Okay, it's owned by the business, and it's also expected to benefit future operations. Okay, so these are three main categories or three main characteristics of an asset. So for an example, right, let's say a company has land that all of its buildings and factories are sitting on. Is this an economic resource? Of course. Is it owned by the business? Yes, if I have land listed under assets, that means I own the land. I'm not just renting it. And would we expect this land to benefit us in future operations? Of course, because why do you purchase the land in the first place, right? To benefit operations. That's where I'm putting my buildings. I need space to actually run my business, right? And one of the most obvious assets that we'll always see is that of cash. Okay, cash is obviously an economic resource. It helps us to purchase things that we need and satisfy obligations. Cash is owned by the business, and of course, this is expected to benefit future operations as well. And often, though, because cash is the most liquid asset that we'll be looking at, in most cases, when we're talking about benefiting future operations, that's usually in the form of positive future cash flows. So, for example, if I have inventory, what do you expect to do with this inventory? You expect to sell it, right? And eventually, when you sell it, that you expect to turn that into cash, right? That is going to benefit future operations. Or if you have an accounts receivable account, which means that's just the account that shows us what our customers or other people owe us. Eventually, what do you expect that accounts receivable to do? You expect it to be converted into cash. You expect to collect your cash, right? So that's going to benefit us in the future as well. Okay, so that is a summary of what an asset or asset. Now, what about liabilities? Okay, let me just going to try and zoom out here slightly. Okay, because we said part of the balance sheet is also liabilities, right? So what the heck is a liability then? Okay, liabilities, you can think of it as debt, right? It's basically financial obligations of a company. Okay, so financial obligations or debts. It's basically what, if you're looking at those different liabilities, it's basically what the company owes to others. So it represents future negative cash flows. So how can that be? Well, if you think about a bank loan, doesn't a bank loan need to be paid back, right? So if you will look at a note payable, which would be a bank loan, a note payable, if we loaned money from borrowed money from the bank, that note payable has to be paid back at some point, right? And that is going to cause us to have a cash outflow, a negative cash flow. Okay, so that's an example of why these debts or these financial obligations represent future negative cash flows. Okay, and when we're talking about owing money to someone else, that's those groups that we owe money to, is what we refer to as our creditors. Okay, and usually your liabilities, when you're looking at a company's liabilities on the balance sheet, they need to be listed in the order of liquidity. Assets as well, okay? But listed in the order of liquidity in that you have to list these liabilities in the order in which they are expected to be repaid. So those obligations that expect to be repaid sooner rather than later will be higher on the list as opposed to those loans that aren't expected to be paid until later. So for example, our accounts payable in this case, so this screenshot probably isn't the best example because it doesn't look like they probably did the best job of listing it in order of liquidity, but that's a good thing, so I can actually point that out to all of you. So usually salaries or accounts payable, usually those are the kinds of liabilities that for most companies are going to become due or need to be repaid before something like a notes payable needs to be repaid. Just depends on the terms of the loan. So if you're looking at this list here, if let's say our salaries payable is going to be due within the next 2 weeks, we have to pay that $3,000 to our employees within the next 2 weeks, but let's say the accounts payable and the notes payable isn't due until the next month. We'd probably want to move to follow that rule of liquidity. We want to move that salaries payable and probably list it first. That's just best practice. Okay, so I just wanted to point that out because we'll be working with that later on as well. Okay, and just keep in mind that liabilities also represent claims against the borrower's assets. Okay, so if a loan isn't repaid, then they have a claim to the company's assets that we talked about just a couple of moments ago. Okay, last but not least, that third element of a balance sheet is owner's equity. Okay, what the heck is owner's equity? This represents the owner's claims on the assets of the business. Okay, so represents the owner's claims on assets of the business. Okay, so owner's equity looks a bit different depending on what kind of business you're looking at. But for our purposes, when we're looking at corporations, owner's equity is mostly going to, at the basis of it, because we'll expand on that a little bit way later on. But at the basis of it, the two accounts that owner's equity is made up of would be your capital stock and your retained earnings account. Okay, so The capital stock refers to the amount of money that has been invested in the business by investors, by the owners. Okay, and retained earnings refers to how much you kind of look at the name, it kind of gives it away. How much earnings have been retained within the business and not been paid out? How much is left of earnings since the company came into existence? Now, when it comes, let's say in the unfortunate event a company goes into bankruptcy. The group that has first claim on assets until they are paid back what they are owed are the creditors. Okay? After the creditors are paid, the investors have residual claim on any assets that are left over. Okay? So that's just an important point to make there. So your owner's equity, remember, it's just represents the owner's claims on assets of the business. And what is that made up of? For a corporation, that's made up of capital stock, what's been invested by these owners into the business, and retained earnings, basically how much net income has been retained within the business since the company has been in existence. Okay? So that is the overview of really what comprises a balance sheet, what a balance sheet is made up of. Okay, so a balance sheet, it's made up of assets, liabilities, and owner's equity. Okay, so as we go through the basics, really up into chapter 5, it's going to be probably the most important because that's where we're looking at the basics. But really, chapter 2 and 3 are some of the most important chapters because without them, chapter 4 and 5 are going to be incredibly difficult, as well as the rest of the class. So you have to make sure that you're really paying attention to any questions you might have, and make sure that you really have a good handle on chapters 2 and 3 once we finish off those chapters and that homework becomes due. Okay, it's going to be very important. And I don't say that to intimidate you. That's just how this class works. We really need to make sure we lay a very good foundation of these concepts because it's going to make the rest of the class a lot easier to follow along with. All right, and so before we move on, I just want to make some points further about owner's equity and then assets. Okay, so with owner's equity, we might be wondering, well, how does that come about? Right? So owner's equity can either go up or down. So the question is, how can owner's equity go up? Okay, where does it come from? And it comes from two main sources. Okay, so the first source that it comes from is investments by investors or owners. So investments of cash. Okay, but it's not always cash. It can be other assets. Okay, by owners. So investments by owners. So in the case of a corporation, that is someone buying stock in the business, right? Or if it's a private business, that would be the owner actually putting his or her own money into the business. Okay, so that is where the capital stock would come into play, is the purchase of stock. And the second source is earnings from profitable operations. Earnings from profitable operations. In other words, earning or generating net income for the period. Net income is going to increase this retained earnings balance. Okay, so those are the two main sources that owner's equity comes from, and that will cause it to go up anytime someone invests more in the business and anytime that the business actually generates a net income. But it can also decrease. Okay, so it can decrease in two ways. The first way is payments of cash or transfers of other assets to owners. Okay, so I'll just say payments to owners. So a very common example of that, especially in this class, would be dividends. Okay, dividends represent payments to shareholders, and that reduces owner's equity by reducing our retained earnings. Okay, and the other would be losses from not profitable operations, but from unprofitable operations. because if the generation of net income increases owner's equity, then if I were to have a net loss, that should have the opposite effect. Okay, so owner's equity goes up by someone investing into the business or the business generating net income, but owner's equity will also go down in the event that we make payments to owners or we have a net loss for the period. Okay, now one more important, because this is not going to be the quickest point to make, but assets. When we account for assets, there are some assumptions and key points that we need to keep in mind when it comes to accounting for assets. Okay, some principles that need to be followed, and that's going to follow us throughout this class. So the first principle I want to talk about is the cost principle. Okay, this relates to assets. Okay, basically what this says is that assets, not all of them, but some assets, in many cases most assets, need to be recorded on the balance sheet at their historical cost. Okay, assets are recorded at historical cost. Now, what is historical cost? Okay, that simply refers to the original amount that was paid to acquire an asset. So if you bought a building for $200,000 back in 2001 and the company still owns that building, it's going to be listed at $200,000 still on the balance sheet. Okay, some examples of assets that are recorded based on their historical cost would be things like land, buildings that I mentioned, and inventory. Okay, and also equipment is a account that we'll see a lot in art class. So those items are examples of assets that will always be recorded at their historical cost. What did we initially pay for them? That's how they will be reported on the balance sheet. Okay, but this is not always going to apply, which you'll see when we move on to later chapters. Some assets that are not reported at historical cost, some examples of those assets would be accounts receivable and investments, as an example. Okay, so accounts receivable, that is going to be recorded at its net realizable value, which we'll talk about later on in this class. And investments are always going to, depending on the investment, will be mostly marked up to their most recent market value or fair value. Okay, so that is the cost principle. That's the basic idea behind the cost principle, and that's what we need to keep in mind when we are accounting for assets through journal entries and when those asset balances go onto the balance sheet. That's the cost principle. The other principle is the going concern assumption. Okay, the going concern assumption, it's really just an assumption that we're making when we're working through all of this material. Let's assume you're an accountant that's charged with recording transactions for a business and putting together its financial statements. One assumption that you're making while doing that work is the going concern assumption. You're assuming that the business will continue to exist into the foreseeable future for an indefinite period of time. Okay, because we're not just assuming, oh, the business is going to go bankrupt tomorrow. The assumption that accountants make when they're doing this work is that the business is going to operate into the foreseeable future. Obviously, if we know a business is going to go into bankruptcy or there are issues that threaten its existence, that's a different concept and different topic. But for the most part, if we're looking from the accountant's perspective, and doing accounting work and bookkeeping, you're doing all of that with the assumption that this business is going to continue existing into the foreseeable future. Okay? And another principle when it comes to accounting for assets is the objectivity principle. Okay, what does it mean to be objective? Okay, objective describes information that is factual, definite, and verifiable. So if information is objective, it lacks subjectivity. Okay, so objectivity is a primary reason that we will record many assets at their historical cost. Why? Because guess what? Historical cost, that is most definitely verifiable. Can I easily figure out how much they paid for their building or their land? Of course, that's a verifiable thing. It's either an amount or it's not an amount, right? But if you ask someone, let's say, what a piece of land is worth, that might generate more than one opinion, right? So historical cost is something that's verifiable. I know what I paid for something. But if you ask someone, hey, how much is my land worth? That might not be as objective as being able to say what something had cost you in the past. Okay? And objectivity is very important for accountants when doing their work. Another principle, or assumption actually, is the stable dollar assumption. Okay? So one limitation of us actually using the cost principle to record assets at historical cost is the fact that monetary units like the dollar, they're not always stable, right? They can actually be quite volatile depending on the economic climate. Okay? If many of you probably taken economics, so you're familiar with the terms inflation and deflation, right? Inflation, when there's inflation present, that describes a situation where the dollar loses its value and it can now purchase less than it could before. The value of a dollar declines. I'm going to have to spend more on a given item than I had to in the past, right? A loaf of bread, for example, if inflation is present, a loaf of bread is going to cost me more, although it's the same loaf of bread, than it did in the past. Okay? Deflation is the opposite of inflation, where the value of the dollar is actually going up and it has more purchasing power, so it can actually purchase more than it was able to in the past. So when deflation is present, a loaf of bread is actually going to cost me less than it did in the past because that dollar that I have in my pocket actually has more purchasing power. Where if there's inflation, that dollar now has less purchasing power than it usually did. So this is inflation and deflation. That's just the reality when it comes to economics and looking at just any country's economy, right? It's not to say that the dollar is going to be stable. It can be volatile. There can be inflation or deflation present, but with our economic climate, usually inflation tends to be the overall trend as the years go on, okay? But because of this instability of the dollar, any currency that we're looking at, accountants, especially if now we're looking from the perspective of the United States, accountants in the United States, when they're preparing financial statements, they just make the assumption that the dollar is stable. And they treat it like they would units of measurement, like a gallon, a mile, right? Inches, for example, right? If I measure a gallon of milk, right, if I'm just measuring it, a gallon is a gallon, whether it's tomorrow, 5 years ago, 100 years from now. A gallon is a pretty much standardized unit of measurement, just like a mile, or if you're measuring something in inches, right? The volatility of the economy is not going to impact these measurements, right? Something's either 2 miles or it's not 2 miles, right? But because of the nature of how economics works, a dollar doesn't behave in the same way, right? A dollar's value can go up and down as time goes on, but because that's the reality, it complicates an accountant's job. So for that reason, accountants, when they're setting up these financial statements, they just assume the dollar is stable and treat it like these other units of measurement. Okay, so that's a very important assumption that we need to just keep in mind as we work through this class, because it really helps to make the work a little bit easier. Because there are, especially with advanced accounting, there are situations in which the volatility of a currency is taken into account when accounting for certain transactions, of course. But for a lot of it, a dollar is just assumed to be stable. But that's a little bit beyond the scope of this class. Once you get into more advanced accounting classes, that's when you'll actually take a look at the effects of inflation, deflation, and also currency translations when you're going from one currency to another. Okay. So we've talked about assets, liabilities, and owner's equity. Okay, assets, liabilities, and owner's equity, and guess what? Okay, we said all three of these show up on the balance sheet, right? That means they're all connected in some way or another. One very, very important equation, and don't let the word equation freak you out. There's one very, very important equation in this class and in just accounting in general called the accounting equation. This is going to form the foundation of everything that we do in this class, basically. Okay? And if we can master this over this chapter and the next chapter, it's going to make our lives a lot easier as we move along in this class. Basically, what the accounting equation says, it says how these three elements relate to each other. Okay? And that accounting equation is as follows. Assets will always be equal, so total assets will always be equal to a company's total liabilities plus its total owner's equity. Okay? If you don't believe me, I'll paste that balance sheet back in here. You see here that the total assets of $300,000 is equal to the liabilities and owner's equity total of $300,000 as well. Liabilities of $80,000 and owner's equity of $220,000 gives me $300,000. Okay? And we'll jump into that equation a little bit deeper when we go over some example transactions in another video. Okay? But one example would be, let's say my asset balance is $100,000. Okay? And let's say my liabilities balance is $20,000. Can I figure out how much the owner's equity of the business has to be? Of course I can, right? You're solving for X if we want to look at this from an algebraic perspective, right? If my total assets are $100,000 and I know assets are equal to liabilities and owner's equity added together, okay, that means my owner's equity must be equal to $80,000. We can always find a missing piece if we know the other two, because $100,000 of assets is equal to $20,000 of liabilities plus $80,000 of owner's equity. So that checks out. This equation is equal, it balances. Okay? So I hope you're taking notes while you're watching this video, because there are some very key points that you will definitely be coming back to as we progress further throughout not only this chapter but this class. So there's a lot going on with the balance sheet, but we also have two other financial statements, and one other one is the income statement. Also a very important financial statement. Okay, so your income statement, in the most basic, looking at the most basic definition we can, your income statement is basically just what are the company's revenues and expenses. It looks at your revenues and expenses for a period of time. But remember, is this a snapshot statement? Is this the one where it looks at one specific moment in time like the balance sheet? It does not. It's not a snapshot statement. Remember, this is more like a film or a movie statement because it covers a period of time. Okay? For, let's say, the whole fiscal year, as opposed to just that last day of the fiscal year like the balance sheet we'll look at. Okay? So it's basically just an activity statement that shows how many revenues came in and how many expenses did the company incur from this date all the way to this date. Okay? Revenues, they generate positive cash flows through our transactions with customers, right? So that's like making a sale. right? We're going to be looking at many examples where you're making a sale or you're rendering services to a customer, and what do they give you in exchange for services or a good? Money, either cash today or a promise of cash later. Okay, so we're looking at revenues. I'm not going to go into too much detail because I don't want to confuse you, but let's just say that this company mows lawns and you mowed the lawn for a customer. Okay, let's say it cost $50. If that customer pays you the $50 right away, does it qualify as revenue? Yes, of course. If you mow the lawn and they promise $50 next week and you've made an agreement with them that they can pay you next week, does that still count as revenue? Of course, it does. Cash doesn't have to be received at that moment in time for it to be qualifying as revenue. It qualifies as revenue as long as there's an exchange that took place. Here, we rendered a service, on this example, you rendered a service in exchange for what? Cash today. But in this example, you rendered a service in exchange for a promise of payment later on. So there's still an exchange that took place, so that would still qualify as revenue. And expenses are those things that we incur in order to keep operations going. So example, fuel expense, you need to fill up your vehicles, right? Or the utility bill that comes in the mail, right? All of those are seen as expenses, okay? And expenses, they represent negative cash flows through business activities, either presently or in the future. So fuel expense might be an example of something that is paid right away. But a utility bill, usually you have until a certain date to pay that bill off. But it would still be seen as an expense because you already incurred that expense by using up those utilities, although you don't have to pay the bill until a later date. But I don't want to get into too much nitty-gritty detail there. The main idea I want you to take away, at least for the purpose of this chapter, is what is an income statement? It's a financial statement that covers a period of time that shows us what revenues and expenses apply to this business for that specific period of time through the activities that they engaged in, how much revenue was generated, and how many expenses were incurred. Okay, and when you put all of that together, your income statement will tell you exactly what the net income for that business is for that period of time. Your revenue minus your expenses gives you your net income. Okay, so if I generate revenue of $2,000, but I had to spend $1,000 on expenses, that means my net income is $1,000. So basically, if you look at revenues minus expenses equals net income, that is your income statement in a nutshell. Okay? And lastly, our statement of cash flows. We're not going to go into too much detail here because we'll have an opportunity for that later on as well. But a statement of cash flows. Okay, really, what are we looking at with that? Well, one thing we know for sure is, because the name kind of gives it away, is that a statement of cash flows involves cash. Basically shows you cash inflows and cash outflows. Okay, basically what kind of cash came in and what kind of cash came out or flowed out of the business due to our business activities for this period. Because remember, this statement also covers a period of time. Okay, it's a film statement, just like an income statement is. It's not a snapshot statement. So it's basically just a summary of what cash came in and what cash came out for the period that we're looking at. The statement of cash flows, you'll have your beginning cash balance, and it'll show how cash went up and how cash went down. And then guess what? We'll be able to see, okay, what's our ending cash balance for the period? Okay, and guess what? Just a little preview, where if we know what our ending cash balance is, what statement do you think that will then go on? What financial statement will we see cash on? Our balance sheet. Okay. And these cash inflows and outflows, they are broken down into 3 cash flow categories. We have operating activities, investing activities, and financing activities. I need to spell that correct. Activities. Okay. So under the operating activities category, that just shows you what cash came in and out due to just us operating the business, right? That would include cash revenue coming in, right? Or any cash expenses. Investing activities, that refers to any cash in or out resulting from us investing back into the business. So this would include, let's say you bought a new building, right, to expand operations. If you bought a new building, it's yours, that is an asset. That would count that amount of cash that you spent on that asset, any cash down, or if you bought the thing for cash completely, that would be a cash outflow that would be seen under the investing activity category. Okay, so any cash coming in or out due to us investing back into the business. So also an example is if the company bought an asset specifically to be resold for a profit, any of those cash flows would also be shown under that category. And financing activities, that's any cash in or out resulting or related to financing. So if you have some shareholders that gave you $10,000 cash in exchange for some shares, that's a cash inflow that would show up under financing activities because what do we use that money for? It's used to finance the business. Okay. Also, if I take out a new loan from the bank I loaned $100,000 from the bank, that's a cash inflow. But why am I borrowing money from the bank? To finance my business and to finance different elements of my business. So that would be a cash inflow under this category. But then what happens when you have to pay that loan back? That would be a cash outflow that will go under this category as well for the period. Or when I'm paying dividends back to my shareholders, that's a cash outflow. Payment back to my owners, that would be also linked to our financing activities. Okay, well, have a chance later on to actually practice setting these statements up when we've gotten through more material. But that's basically just the main idea behind these 3 primary financial statements. Okay, so again, just make sure you're taking notes as you go along and you make note of any questions you might have so we can make sure to cover those when we meet over Zoom. Okay, so be on a lookout. I'm going to be making just at least one more video for this chapter. So look for the chapter 2 lecture videos within the chapter 2 module.